Welcome to the Deep Dive. We're your shortcut to getting up to speed on important company updates.
And today we're diving into Employers Holding Inc. That's ticker EIG.
Yeah, specifically their Q3 2025 earnings call. And, well, it was quite the quarter. High drama, maybe low profits.
That sums it up pretty well. This was really the quarter where management, well, they took some necessary pain, decisive, maybe surgical pain.
Okay, so what's the big picture then?
The theme is crystal clear. They pushed through a massive kind of off-cycle reserve action needed for the long-term health of the balance sheet, absolutely.
But the market didn't like it much in the short term.
No, not at all. That decisive move led to immediate skepticism. The shares dropped pretty sharply right after the news hit.
Okay, let's get into the numbers then, the headlines. And yeah, they look tough.
They do. GAAP EPS, that was a net loss, negative 36 cents per share.
And the non-GAAP, the adjusted number.
Even worse, actually, a really severe miss at negative $1. Consensus was looking for something positive. So yeah, a huge disappointment.
Wow. Okay, but I thought I saw something about revenue.
You did, that's the twist. While the bottom line sort of collapsed, the top line was actually strong. Total revenue hit about $239.3 million.
Which beat expectations.
Yeah, beat expectations. Up 6.8% compared to last year.
And premiums.
Net premiums earned also grew, up 3% year over year to $192.1 million.
So, okay, strong revenue coming in the door, but a massive hole in profitability. How bad was the underwriting loss?
That's where the combined ratio tells the story. It surged all the way up to 129.7%.
Oof. Compared to what, last year?
Compared to 100.4% last year. So a huge jump.
And just to remind everyone listening, a combined ratio over 100%, well, that means you're losing money on your core insurance business, right, for investments.
Exactly. That high combined ratio, it's the direct result of that big reserve strengthening action management took.
But despite those grim numbers, the board seemed confident. I saw something about the dividend.
Remarkably confident, yeah. They declared the regular quarterly dividend, 32 cents per share. And maybe even more importantly, they committed to a very aggressive capital plan, which we'll get into.
Okay, definitely want to talk about that. But first, let's dig into the core issue here, that balance sheet reset. What exactly happened?
Right. So the main driver, the thing causing that big loss, it was hyper-concentrated. One specific issue.
Which was?
A $38.2 million prior year reserve strengthening, and it was almost all about California cumulative trauma claims, CTE claims.
$38 million. That's a big number. How does that relate to their overall reserves?
It's significant. That adjustment was about 2.8% of their total net unpaid loss and loss adjustment expense. LNLAE is the acronym you'll hear.
Okay. And focused on which years?
Primarily focused on claims from accident years 2023 and 2024, so fairly recent years.
So what makes these California CTE claims so insidious? Why did they need this big off-cycle $38 million fix?
Well, it's a combination of things. Timing is a big part of it, and some specific California regulations.
So?
These CT claims, they're tricky because workers can often file them retroactively. Sometimes, like long after they've even left the company.
Okay, so it takes time to show up.
Exactly. And management pointed out this increased CT frequency trend. It didn't really fully emerge until well after the first year of those accident years, 2023 and 2024.
And something else was masking it.
Yeah, to make things even more complicated, they had a declining frequency trend in their non-CT claims.
So the good news hid the bad news for a while.
Pretty much. It delayed the visibility of this growing CT problem.
Okay, so management's position now is this is a one-time thing. A targeted cleanup.
That's the argument, yes.
But we've heard one-time charge before, right?
Yeah.
What makes them confident that $38.2 million is really the end of it, not just step one?
Well, they're framing it as a conservative adjustment and specifically targeted. They're saying, look, this is about the structural issues in California. It's not, a sign of deterioration across their whole national book of business.
And do they have any backup for that view?
They did point to a mid-year independent external actuarial review. Apparently, that review supported their internal reserve selections, so that adds some weight to their claim that the number is robust.
Okay, so they took the hit. Looking forward now, how does this change things? Do they adjust guidance?
They had to, yeah. To reflect this sort of new, more conservative stance, the current accident year LNLAE ratio pickup for this year, accident year 2025, that was increased.
From what to what?
From 69% up to 72%, so baking in more expected losses going forward.
And how do they plan to fix that underwriting margin then? get that combined ratio back down?
It boils down to two main things: getting more aggressive on rates, getting price, and refining their underwriting significantly.
Specifically in California, what are they doing there?
Yes, very targeted actions in California. They're pushing for rate increases that actually exceed the official bureau filing rates, so getting more price than maybe the baseline suggests.
And operationally?
Operationally, they're implementing more aggressive claims handling, more litigation management, especially going after what they called non-medically associated CT claims.
Meaning claims they think might not be entirely legitimate.
That seems to be the implication, yeah. Trying to weed out the ones where the injury might not be directly work-related in the way the rules intend. Plus, they're continuing to diversify geographically, of course.
Are they trying to fix the underlying problem too, the California rules themselves?
They are. They confirmed they're actively pushing for legislative reforms in California, trying to get the state's CT rules more aligned with other states that are, frankly, less volatile for insurers.
A permanent fix would be ideal, obviously.
Absolutely. That's the long-term goal.
Okay, so while they're fighting this fire in California, it's important they're still growing the business elsewhere and getting more efficient, right?
Yeah.
What did the operational picture look like outside of this reserve issue?
Surprisingly strong, actually, which is maybe part of why they felt confident taking this big charge now.
How so?
Well, even though they said they're prioritizing underwriting margin over just growing for growth's sake, their policies in force hit a new record.
Really? How many?
Over 135,414 to be exact. That's up 4% year over year.
And where's that growth coming from?
Mostly driven by success in their small commercial segment. It seems like their investments in automation and making things easy for agents and customers are paying off there.
That leads to efficiency too, presumably. How did they do on expenses?
That was another bright spot. The underwriting expense ratio dropped quite a bit, from 23.5% down to 20.6%.
Nice drop. What drove that?
It was mainly the result of a recent reorganization they did, specifically designed to reduce compensation costs.
Sustainable, though.
They think so. They also mentioned further improvement is expected as they execute on this multi-year AI roadmap they have, focused on automating more of the customer journey.
Interesting. AI in insurance ops. And what about new business lines? Any diversification efforts?
Yeah, they announced a new product launch, an excess workers' compensation offering.
Oh, okay. When's that coming?
Targeted for early 2026. It seems like a natural extension for them.
Leveraging what they already do well.
Exactly. Leverages their existing expertise, their systems. It should broaden their market relevance, deepen relationships with agents, without needing massive new spending on infrastructure.
Right. Okay. This brings us, I think, to maybe the most dynamic part of the call. Despite this quarter being defined by, well, pain, management's response on the capital front was immediate and remarkably confident.
It really was. This is the key counter-narrative to that negative earnings headline, a true power move, you could say.
Okay, lay it out. What did they do?
It was two things, basically. First, the board approved a $125 million debt-funded recapitalization.
Okay, borrowing money. And second,
they simultaneously expanded their existing share repurchase authorization, added another $125 million to it.
raising the total buyback plan too.
A massive $250 million.
Wow. Okay, so borrowing $125 million and potentially buying back $250 million worth of stock over time, that's aggressive. What about the cost of that debt?
Crucial point. They mentioned the funding sources, including the Federal Home Loan Bank, FHLB, and the rate, an impressive fixed rate of just 3.7%.
3.7% fixed.
Yeah.
In this environment. That's really low.
Incredibly low, yeah. And they didn't waste any time putting capital to work either. They were buying back stock pretty aggressively during Q3.
How much?
$45.2 million worth, executed at an average price of $43.39 per share.
Okay, $43.39. And what's their book value per share right now?
Adjusted book value per share is $51.31, which, by the way, is up 5.5% year over year, even with the tough quarter.
So buying back stock well below book value, that's highly accretive, obviously, stepping right into that discount caused by the earnings news.
Exactly. Buying with both hands, you might say. They used about $65 million under the previous authorization plan, which leaves
$185 million available under the new expanded $250 million authorization.
Right. $185 million left to potentially deploy on buybacks.
Okay, let's connect this back to the market reaction. The stock dropped, what, about 8% after the report?
Roughly, yeah.
So the market's real concern isn't necessarily the loss itself. It's more about the future, the timeline.
I think that's fair. What are investors really skeptical about?
Well, it seems to revolve around whether that $38.2 million reserve charge is really enough. Is it sufficient to permanently close that California CT gap?
Mm-hmm.
Or is there more bad news lurking, more tail risk?
Okay, so is the fix really fixed?
Right. And the other big question is timing. How long is it going to take for those rate increases they're putting through in California to actually earn through, flow through the premiums and start bringing that 129.7% combined ratio back down towards profitability?
Debt earned through timing is key in insurance, yeah. Takes time for rate changes to impact the bottom line.
What about the bigger picture? Any macro tailwinds helping them out?
Well, generally, the commercial P&C insurance market is still seeing pretty firm pricing overall. That definitely supports their efforts to restore margins. It's easier to get rate when everyone else is too.
And interest rates.
Higher yields are also supportive, boosting investment income. Their portfolio is helping the weighted average book yield is currently sitting at 4.6%.
4.6% yield on investments versus 3.7% cost on that new debt. That's an interesting spread.
It is. We'll come back to that.
Okay. But first, any specific risks management called out? Anything they're particularly worried about?
They actually noted that overall medical cost severity trends, so how much individual claims cost, they remain below pre-pandemic levels. So that's kind of a check mark in the positive column, not seeing runaway medical inflation right now.
Okay, good. What about the economy? Recession risk?
They did acknowledge that, yes, in a recessionary environment, claim frequency could rise. More people might file claims if jobs are scarce.
But it depends.
Yeah, they noted the impact is usually pretty specific to the nature of the downturn. Not a given, but something they're watching.
Okay, so boiling it all down, if you're watching EIG, what are the key catalysts? The main things to track to see if management strategies, the cleanup plus the capital plan is actually working.
I'd point to three main things. First, and most obvious, sequential improvement in the combined ratio. That's the primary metric showing earnings repair. Quarter over quarter, does it get better?
Makes sense.
Second, look for any evidence, any commentary, suggesting that CT claim frequency and severity trends are finally stabilizing in California. Is the bleeding stopping?
Right. Proof the reserve charge was enough. And
Third is execution on that capital plan. Watch the pace of the buyback. Are they really using that authorization aggressively? And how are they managing the debt-funded recapitalization?
Got it. Combined ratio, California stabilization, and buyback execution. Okay.
Yep.
All right, let's shift gears. Time for the most aggressive part of our deep dive, our outrageous but maybe plausible trade ideas segment.
And the crucial reminder first.
Yes, this is not financial advice. We are just exploring ideas based on the information presented. Do your own homework.
Absolutely. So the setup is this. The stock's trading at a pretty significant discount to its book value, as we discussed.
Right. Bought back shares at $43, book value over $51.
And the company has just committed to this big capital deployment strategy, funded partly by that very low-cost fixed-rate debt.
Okay. So the trade idea leverages that.
Exactly. It's essentially a leveraged capital structure play.
Walk me through the leverage again.
They successfully secured that debt at 3.7% fixed. Compare that to their current average investment portfolio yield of 4.6%.
Okay, so they borrow at 3.7%, invest passively at 4.6%. There's a spread there.
A clear spread. Almost 100 basis points, or 1%, of basically risk-free interest arbitrage between their cost of debt and their investment income, just sitting there.
So what's the aggressive, outrageous, but plausible move to maximize that?
The move is full and immediate deployment, like right now. Meaning the company should take that remaining $185 million buyback authorization and just deploy it fully, immediately. Use that low-cost debt they just raised.
To just hoover up as many shares as possible while the stock is down here?
Exactly. Execute the maximum possible share retirement while the stock is trading at this valuation. You aggressively leverage that fixed-rate debt arbitrage borrowing cheap to retire equity that implicitly earns their higher portfolio yield to dramatically boost earnings per share and return on equity.
Forcing the market to reconsider the valuation.
That's the idea.
Yeah.
Force a rapid market re-rate, push the stock price far above where it is now by fundamentally changing the per share math very quickly.
Wow. Okay, that is an aggressive lever pull.
Yeah.
Use the capital opportunity they just created to its absolute maximum right away.
It's bold.
Yeah.
Takes advantage of the market's short-term reaction to the reserve news.
Definitely an outrageous but plausible scenario to think about.
For sure.
Okay, let's wrap this up then. To recap Q3 for Employers Holding, it was definitely challenging. Dominated, really, by that painful California CT reserve action that clearly shocked the market.
Yeah, but the counter metrics here are really important. You have strong operational efficiency gains happening in the background. And this new, very aggressive debt-funded capital plan, that's designed specifically to support the per-share metrics through this earnings repair period.
So the key thing for you, the listener, to watch going forward.
It really comes back to that combined ratio trend. Management has taken its medicine, so to speak, but the proof is going to be in the pudding. How quickly do those California rate increases earn through? How fast does that combined ratio stabilize and start moving back towards profitability in the coming quarters?
That seems like the number one thing to track.
Absolutely, along with the pace of that buyback we just talked about.
Great stuff. Thanks for joining us for the deep dive. Please remember to watch those catalysts we discussed, especially that combined ratio and the buyback pace.
And we'll catch you on the next deep dive.